is up, everybody? Super excited to have Jack Niewold on the podcast today. I've been following him on Twitter for a good time now. He has very insightful threads, a very insightful newsletter. In particular, his thread on Celsius and a breakdown of what happened went viral. So we thought he would be a perfect guest to have on the show and discuss the entire situation, break it down, and go into detail about it. So Jack, thanks a bunch for jumping on. If you want to start maybe with some quick background on yourself, and then we can dive right into it.
Yeah, absolutely. Thanks for having me. I bought crypto for the first time in 2017. Bought some Bitcoin and Ethereum, trying to get rich. I don't know. I was in college, like 19 or 20 or something. Just like hodled through the bear, forgot about crypto for a little while and came back to it in 2020 and, fell down the rabbit hole and then eventually started the newsletter Crypto Pragmatist, which is kind of how I pay the bills. And I'm on Twitter a lot, so have kind of accrued a bit of a Twitter following in the last year or so. And always a good time in crypto. Never a dull moment.
Never a dull moment, especially the last 70 days. I saw a tweet, forget how long ago it was. I think it was like last week, that was discussing how, Bitcoin was 48K in April. I think people don't realize like how fast things change. And one of the big things that led to this change was obviously what happened with Luna. I think everyone's kind of aware of what happened there, but then that spilled into Celsius. So let's dive in. I think a good place to start is, what is Celsius? And it's part of this broader theme of centralized DeFi. So if you can provide some background on Celsius and this C DeFi concept that emerged over the past few years.
Yeah, so, there are a number of these kind of centralized DeFi platforms, and they've all sprung up. I think maybe some of them were kind of starting to come online in, some variations in like 2018, 2019. And then 2020 was really when we started to see a lot of movement. And the idea is basically like, okay, DeFi is great. And there's all kinds of ways to like use assets in interesting ways and earn yields on assets or yields on stable coins. And, but it's complex, right? So what if me, instead of like having my MetaMask wallet and I'm going into Compound and lending it out on Compound or leveraging all these assets in different ways, what if I just give it to like a centralized custodian, like a company, and a US based company in this case, and they kind of just do all that hard work for me. And then I get my yield and whatever token. It's, I can deposit ETH and get 5% on ETH. I can deposit stable coins, get 12% on stable coins. And that's kind of the concept behind all of these platforms. On
that point, is most of the investing on these platforms stable coin yield generating type investments, or they also have, more risk strategies in place as well?
Well, it's a bit complex, right? And this is kind of the first issue, is that these are kind of black boxes and that they have tons of wallets that they don't disclose. So you can't track kind of all the movements that are happening. They won't kind of disclose necessarily the direct strategy behind where the yields are coming from in a particular deposit you make on their platform. So it's all obfuscated. And even if you wanted to track it, they're doing stuff on centralized exchanges or they're lending out assets over the counter. So it's all kind of obfuscated in some way. So that's kind of the first issue. But they also, they're also lenders, right? So they're also kind of operating and lending out capital to both like clients and to institutions. There's a lot to the business model. They're kind of acting as like hedge funds plus banks plus, OTC desks. There's a lot of kind of business units in each of these centralized DeFi platforms.
And in general, were they marketing yields that were higher than just going on Compound yourself or just going on yourself?
Yeah, so I think yes, typically yes, and these yields kind of came from a couple places. So first of all, often, and Celsius is a great example of this. Celsius, what they do is they pay out they have an option to pay out part of the yield in a token, right? So they have the company launches a token, the token is worth, I don't know, 50 cents, and then they pay you 8% in stable coins, and then they pay you an additional 2% if you want to get all of your yield paid back in Celsius. So it's a bit of a strange dynamic with that this kind of like economic model where they're paying out a yield in the native token. And where does that kind of money come from? It's a bit like having your own money printer, right? But I think it varies. You know, sometimes the yields are advertised as being lower. In a lot of cases, they're advertised as being higher. And particularly recently, almost all of the yields have been higher than you can get in DeFi, you know, on chain. And I'm sure they would argue, you know, oh, it's because we are we're venture backed and we kind of are using this as a growth strategy. And other people would say, well, this is just not sustainable. You can't keep up these yields for very long.
Right. So basically, tons of users come in, they're attracted by the yields. They're also attracted by the convenience. So one-click solutions to start earning yield, right, through a Web 2 friendly type interface on mobile. So not really having to go with MetaMask, it simplifies the entire process. So they get a ton of users, people are investing, everything's going great, no serious issues. When did you first notice that, you know, things were potentially off and things were going to potentially start cascading and get worse and worse? What was that first indication that you saw that really signaled that something was wrong there?
Well, I think a lot of, you know, like on-chain maximalists have criticized centralized DeFi, CDeFi for a while because, you know, because of this lack of transparency around how the funds are being managed. But there was never any like issue, right? People could always get their deposits back. It was always this liquid system. In the last kind of maybe 6 months, we've seen tremendous amounts of liquidity getting like flushed out of the system, right? So people are looking to get their funds back, and you know, stuff like Luna has caused like massive institutional players to blow up and assets to be liquidated. So it's kind of this slow deflation of this like bubble, right? The problem with Celsius is that they would lock their assets in places. So one place where Celsius had, I think, about 450 million in Ethereum was on the Ethereum Beacon chain, which is Ethereum's proof of stake chain. And in exchange for locking, you know, Ethereum up on this chain, you can get an interest, you know, yield on your Ethereum, right? The issue with this is no one really knows. Supposedly, it's going to be within the next, you know, year or so, or less, 6 months, when you're going to be able to withdraw Ethereum from this beacon chain. But for now, it's completely locked up on there. So let's say you have $1 billion in Ethereum customer deposits. Celsius has gone and they did the math and they said, okay, well, we're going to lock up half of it so we can earn a bunch of interest. And then to be able to match redemptions, so to be able to give people back their Ethereum denominated funds, we will use this other kind of pile of money. But we want to earn interest, so we're going to lock up this money. When price comes crashing down and everyone wants their money back, now they've got a ton of money locked up, right? Yep. So it becomes this really big issue about like, yes, you are. It's possible that you have enough money to kind of back up everything out there, but it's not liquid, right? So you're insolvent. So it would be like if a bank has a bunch of houses and the lenders stop paying it back. Yeah, they have hypothetically these loans are collateralized, but it's not like the bank can have the dollars today on hand. And that's kind of the situation Celsius ended up in.
Right. So one component is they had this ETH that was locked up in ETH2 that they couldn't access. The other component was Luna. Were they exposed to Luna in any way?
Yeah, so I think the numbers are varying, and there's kind of some different stories out in how Celsius managed the Luna kind of collapse. But basically, we know that there was a Celsius product around UST, so you could deposit UST in Celsius and get a yield. They would kind of one of their managed products was giving you yield on UST. What part of Celsius's business model was they would kind of take the excess assets that didn't need. Well, they do. You know, Celsius is still existing. I shouldn't be talking about them in the past tense, but what they would do is they would take out like the assets beyond what they needed to redeem, and they would kind of go out and use these assets and kind of operate as a hedge fund to try to make a return on these kind of excess assets, right? So part of, you know, some people theorize that one thing Celsius was doing was they were taking, you know, some money and putting it into UST and earning a 20% yield on UST and using that to either pay out depositors or using that with their own funds or you know, they were doing something with it. So now when UST blows up, yes, you've got, you know, $100 million in client obligations that deposited UST with Celsius, but perhaps they also got wiped out on some kind of other chunk of their you know, portfolio, right? And part of, you know, some people at Nansen kind of whale wallet tracking software dashboard were doing some research into like what was happening on chain, and some people, you know, some of these the biggest wallets were Celsius, and part of what caused the Luna UST depegging was Celsius pulling out liquidity from UST and from Curve 3 pool, and that's kind of what some people say that's kind of what triggered the depeg. I think the general consensus is that Celsius lost about 130 million in the Luna depegging, which is obviously, you know, a huge amount of money. But yes, they were absolutely exposed to UST. As to how much kind of it affected the business model, there's some questions, but it obviously didn't help. And then, you know, every dollar that you lose is less dollar of this cushion to match redemptions.
And then at one point, users started finding out about this. They all rushed to withdraw, and Celsius just completely shut off the withdrawals. Are withdrawals still shut off today?
I don't know, honestly. I'm not a Celsius customer. I've never used it. You know, obviously some of the heat has died down around Celsius. But yeah, so they kind of turned on this thing called HODL mode, which was, you know, this marketing PR stunt where they said, oh no, your assets are safe with us, but you can't withdraw them, you know? So like, imagine if you went to the bank and you were like, you went to the ATM, you're trying to take out $200 or whatever. You're like, oh no, you're in cash HODL mode, you know?
Yeah, the ATM cash is HODL mode. Sorry.
Right. Yeah, so you just can't withdraw cash anymore. So yeah, so I mean, the issue with that obviously is, you know, maybe they have the assets, right, but you don't have access to it, and then it causes this cyclical thing where everyone's panicking, right, because they can't get their money out, and now everyone's trying to withdraw, and then Celsius perhaps has enough money kind of on hand to match 25% of the redemptions, but they can't match all of the redemptions, so it turns into this kind of downward spiral.
And was this any way related to the 3AC blow up, or is 3AC more connected to what happened with Luna? Well, I know they're definitely connected with the Luna side, but
right. So 3AC, you know, this big crypto hedge fund definitely lost a lot of money on Luna. So maybe like in the neighborhood of $500 million. It's hard to say if there's like a direct connection to Celsius and 3AC. To my knowledge, what happened with part of the issue with Celsius was this liquid Ethereum staking that was going on. So there's a crypto protocol called Lido, and as we talked about with the Beacon chain, where you can kind of lock up Ethereum in exchange for interest. Lido provides this product that allows you to lock up Ethereum, but it gives you back a token that is representative of this staked Ethereum. For a long time, this was kind of pegged pretty close at a 1-to-1 value. So like one staked Ethereum was equal to one Ethereum on the Beacon chain. And that was great because you could deposit Ethereum, you could lock it up, you could get interest on it, and then you could have this token that was the same value, right? The issue is that this staked Ether token trades at a discount, or trades at some discount likely to, Ethereum, one Ethereum token. And that's because it's not directly redeemable immediately for one Ethereum. So there's some kind of discount that has to take place over time, right? The speculation is that, around the same time that the 3AC rumors started to come out, is that 3AC had a lot of staked Ether on their balance sheets, and they were trying to sell all of it. So when they sell all this staked Ether, that causes the price of staked Ether to drop relative to Ethereum. And then if Celsius is holding a lot of staked Ether, now it's another kind of red mark on their balance sheet, right? That now that they thought that this staked Ether was going to be equal to 1 Ether, but now it's 0.93 or now it's 0.91. So, you're in this case where you have less assets than you need to be accountable for, less assets that aren't enough to match redemptions. So I don't think, to my knowledge, 3AC is not directly connected to the Celsius blowup, but this kind of talks about this broader idea of contagion in the crypto markets. And it's, well, if one participant, if Luna blows up, then that causes 3AC to blow up, and now 3AC has to liquidate all their assets, and now Celsius has to liquidate all their assets because, so it's this kind of contagion, dominoes falling, right? And we've seen this with other crypto lenders, Babel, and now, Hash with Luna, and now Voyager, I think just in the last couple of days, has started to not be able to match redemptions anymore. So it's this idea of contagion and these kind of dominoes falling one after each other.
Yeah, Voyager had I think it was like 600 million in owed assets from 3AC, or 3AC owes them around 600 million.
Right. Yeah, I think it's like 300 million in Bitcoin and 350 million in stable coins or something that Voyager kind of entrusted with 3AC. And I'm pretty sure it was, I'm not sure, I haven't been following the Voyager blow up that closely, but I think it was like an uncollateralized loan, right? They just said, oh, you can just have it.
Yeah. And I saw that their entire token market cap, and I believe their stock market cap combined, is less than the money that they're owed from 3AC.
That's wild. Well, might be an interesting opportunity if they can figure out how to get those funds back, but we'll see. Again, I think this is important to talk about is DeFi is like transparent, right? You can see all this stuff happening on chain, but once you entrust it to a centralized custodian, you don't know where these funds are, right? So, I'm sure Voyager is in a situation where they're looking at 3AC, they're thinking, how much can we get back? Is it all out there? Potentially it's all out there, but there's just no certainty. So when DeFi markets liquidate, they obviously, it crashes price, right? Everyone's selling their assets, and then they have other people have to sell their assets, but it happens in this very orderly way, and it's all kind of programmatic. Where in CeFi, it's like people are dodging phone calls, people are trying to flee to countries where they're not going to get extradited. There's all this kind of, like obfuscation and these kind of tricks that people are running, and negotiations and backroom deals. And that's kind of hopefully what we're trying to move away from by being on DeFi. So,
So where do you see the centralized DeFi space? Do you think it's done, or do you think there's a way to do it right? What's your view there?
I've kind of always been a bit more bullish than the average person in crypto on centralized DeFi, because I think about someone like my mom or my dad, and I say, look, they're just not going to would be willing to put $100,000 in assets on a ledger. I'm sorry. And if you get an insured custodian, right, I can see them being like, oh yeah, I would love to earn 5% yield on my dollars or something, right? So it's hard for me to be completely bearish on the concept of centralized DeFi. And even today, centralized DeFi companies are still in business, right? Celsius is still in business, BlockFi is still in business. Even like Coinbase has some centralized DeFi products where they're offering yield on Ethereum, for example. So I'm not completely bearish on the concept. I think similar to kind of what happened to Tether, where Tether was sued by the US government basically to be more transparent about what kind of assets they were holding on their balance sheet. I think it's possible we see the future of centralized DeFi go that way, where we get laws and regulations around how transparent centralized DeFi companies have to be. Because the issue really isn't, at least so far, the issue hasn't been that CeFi companies are like trying to censor their users, or they're trying to, spend their money on yachts, right? It's not like this corruption necessarily that exists in centralized DeFi. It's this lack of transparency where they're allowed to do things because they're allowed to do things that negatively impact customers because the information isn't clear, because it's not directly traceable what they're doing. So I think like my mom would gladly pay 2% a year of whatever Celsius could earn in exchange for having insurance and having a good interface. But there would need to be more transparency to make sure that all of the assets are accounted for at all moments.
Totally. And I think public audits super important. And I think that Tether analogy is actually great. It is probably going to move towards that space. And I completely agree, because there needs to be some level of transparency. But I do also agree as well with the example of, the parents or the grandparents. People want a sleek interface that's basically automated, and they don't need to, jump through any hoops. And there's platforms that can do that, where the current direct to DeFi is great if you know how to navigate the space. For a lot of people, managing their own key is kind of scary, and they don't want to go through that process.
Right. And perhaps it might be some like crypto native solution. I know Argent is a wallet that incorporates like social recovery. They're built on a zero knowledge proof. So it's not you're not interacting in the same way you would interact with a MetaMask wallet, for example. So, they're interfaces that perhaps are more user-friendly, but they also are completely decentralized. So perhaps there's kind of a middle ground where we see more kind of retail adoption or more broad adoption, and we haven't even seen those products yet. So that's kind of another possibility. But I think there's probably still a place for centralized DeFi out there.
Awesome. And then outside of this centralized DeFi conversation on to regular DeFi, has this made you more bullish on any particular projects?
Oh, that's a good question. It's hard to be bullish on anything right now, but I think there's some cool like structured products in the space right now. DeFi is obviously has been complex. It started off as like money markets and exchanges, right? And then, yield farming, and then it became now there's like V tokens, and you got to lock and vote, and there's so many. It has become so complex to manage your money on chain in DeFi lately. So I'm kind of optimistic on structured products. So I know there's a project called Babylon Finance that they run investment clubs. Index Co-op is a project that like creates index funds for cryptocurrencies. So you can buy one token that is like, 10 DeFi projects, or there's a project called Galleon DAO, which allows you to is a single token that allows you to leverage yield farm Ethereum. But all of these allow you to kind of engage with DeFi, with complex DeFi strategies, but just by buying and holding a single token. So those are kind of that's another kind of approach to DeFi in that it's kind of simplifying the user experience, but it remains completely decentralized, completely on-chain.
Yeah, I'm bullish for those concepts as well. I know Index has the DPI, which is that DeFi basket you were chatting about.
Right.
Another topic I want to get your thoughts on, because I saw you share it, and we can go into quick details on this. Solend. So Solend had this governance vote that kind of came out of nowhere. They're a decentralized lending platform on Solana. I guess if you can just break down what happened there and just get your thoughts on that entire situation.
Right. So Solend is a simple lending platform. So in this case, one of their whale users deposited like $180 million in Solana onto the platform and borrowed $108 million in stablecoin. Now that's collateralized, right? So like they had more than enough Solana to cover the amount of USDC and USDT that they were borrowing at that point in time. What happened later was Solana price tanked, right? And there's a mechanism built into Solend that automatically sells Solana if it dips below a certain price, so that it can kind of like pay back the loan automatically. In this case, the Solana price was getting dangerously low to this level of liquidation. And if this $120 million loan would have liquidated, it would have just like crashed Solana price, but it also had the potential to crash the network itself because of all these like small liquidation bots trying to get a piece of this loan liquidation. And there might not even be enough liquidity on all of the Solana network on chain, right? So the idea that this team had was to kind of manually pass this vote to manually take over the account and to liquidate over the counter. So they would like find buyers for all of this Solana and directly liquidate that account and pay the loan back that way. But that's not really how DeFi is designed, right? That's kind of centralized. It's people taking over an account. It's no longer recognizing the ability for people to kind of control their own assets and and there's an idea in property rights and economics around the ability to forfeit an asset. So like the ability to like abandon your house or abandon your car is an important concept in property rights. So this idea of this whale not being able to control his own account is kind of goes against what I see and a lot of people see as these ideals of DeFi. So that was kind of what was happening with that Solend situation.
So they spun up, this was the first governance vote that they had on Solend, right? So they basically spun up this voting mechanism to address this particular problem, and the vote passed, correct?
Correct. Yeah. Another problem with this was I think like 90% of the vote was a single wallet who voted on this DAO proposal. So it talks about decentralization as well. Is like, is this okay if one person who owns a bunch of tokens is going to make the decision for the entire community?
Yeah, and I think one thing that's really interesting too is how many users, and I use DeFi quite frequently, and I'm not aware when I sign a transaction that they could just take over the entire wallet. And I'm assuming that's not the case for all DeFi platforms. Maybe it's the case for this one because Solend tends to be a bit newer. What are your thoughts on that?
Yeah, there's a whole debate in the community around like immutable code. So I think in this case, the contracts were like adjustable basically. So Yep. They could go in and the system is obviously designed to do this in a decentralized way, but it was open enough. These contracts were not immutable, so they could go in and kind of adjust how this liquidation was going to happen. Protocol. There are immutable protocols exist. One of them is called Solidly, and it was Andre Cronje. There's a big DeFi developer named Andre Cronje. He created this project, and then he basically abandoned it. Like he completely left a month or 2 weeks after he launched this protocol. and it was completely immutable. He had designed this protocol and shipped it, and he hadn't made any changes to it. He made it so that no one could change the code, right? And then when there were problems with the project, then no one could fix it, and he kind of just like left DeFi, and now he's doing something else entirely. So yeah, I think the kind of ideal situation would be that we have perfect protocols and that they all run on immutable code that we can't change. But the reality of the situation is, at this stage in DeFi, we can't just like ship stuff because it's probable that something's wrong or something needs to be changed. So it's a difficult question, and I don't think anyone has a kind of a clear answer on what's better. But I think as a space, we should all strive to get to this idea of immutable code so that the rules are programmed in. We know what the rules are. We can go on chain. We can check what the rules are, and kind of operate in that paradigm, right?
Awesome, and I agree with that point. One last question, and you've been great and extremely insightful, so I appreciate that. One last question for the rest of the year. We're about to reach the 6-month mark for the rest of the year. What are you looking at in crypto? What are you excited about, and what are you watching?
Yeah, it's an exciting time to network. It's an exciting time to build, right? We're clearly in a bear market. As to if we're in a crypto winter yet, I'm not sure. As to if we've hit the bottom yet, I'm not sure. But what I'm kind of watching out for is what are going to be the new narratives to drive adoption to the space. And we saw NFTs was an example of something that brought a lot of people to crypto, and over the last year or two, DeFi in 2020 brought hundreds of thousands of people and billions of dollars into the crypto space. So what are those going to be for the next cycle? Is it going to be GameFi? That's something, I'm not a video gamer. I have not really studied that very closely, but I think that there's a good chance that, crypto games could drive an enormous amount of retail participation. Or perhaps, the tokenization of real world assets. Right now we're seeing US treasuries have higher yields than DeFi. Where are we going to make up that gap, and is there some way we can earn sustainable 10% yields on real estate, for example? Perhaps it's that, or perhaps it's structured projects to drive retail adoption. I don't know, but I think that's what I'm thinking about is, okay, what's going to drive retail adoption in the years to come, and really getting a good handle on that.
Identifying the next narrative is super important. I wouldn't be surprised if it ends up being something around NFTs again, personally, like maybe the DeFi component of NFTs. But I also think Bitcoin in particular is going to have another second wind. But I think when these crazy things happen, people start to appreciate Bitcoin more, and people appreciate the fact that it doesn't change. And sometimes the item that doesn't change ends up being that's kind of like the beauty behind the component, right? Is that you can design it to not change.
Right, and you look at you. It's funny because as someone who loves Ethereum and loves DeFi, it's tempting to be like, oh, Bitcoin's an ancient, Bitcoin's a gargantuan that's never going to change. It's broken, right? No, there are some good aspects about Bitcoin that make it much more durable than other protocols. So I just tweeted yesterday, there's a Bitcoiner down inside all of us or something like that, because it's true, right? It's kind of this ideal situation of crypto. It's like the something that can't be changed, something that we all agree on. And it's a cool aspect of Bitcoin.
Totally agree. And especially for the entire space too, to have Bitcoin in a strong place where you have this one foundational component that's not changing, I think actually allows for more experimentation around the crypto ecosystem, because you have this fallback component as well. So let's see how that plays out. Where can people find you, follow you, subscribe to your newsletter so they can stay up to date with your thoughts throughout the entire bear cycle?
Yeah, you can find me on Twitter at Jack Niewold, or you can subscribe to my email newsletter called Crypto Pragmatist at cryptopragmatist.com.
Awesome. Well, really enjoyed this. You're a great guest, very insightful. And hopefully we have you on again during the bear market so people can get more insights. But definitely subscribe to the newsletter. I know we will. And again, thank you for jumping on.
Hopefully we'll talk during the bull market.
Yeah. In 2 years.